In our lecture this evening, we're focusing on the audit of the revenue cycle. One of the interesting things that we've talked about over the past couple of weeks relates to some very specific processes related to auditing. We've determined that we audit based upon management assertions. We've also determined that there is a process where we assess risk. We look at risk from an inherent risk and a control perspective. We identify the risk of material misstatement, and based upon the risk of material misstatement, we develop a test of substantive procedures to measure monetary misstatement. Now, what we're going to do this night, as well as for the next couple of weeks, is take that information and then apply it to very specific business processes. The first business process that we're focusing on is the revenue cycle. The revenue cycle is simply receiving a customer order. In this process, we're going to approve the customer for credit, determine whether the goods are shipped, shipping the goods, bill the customer, collect the cash, and recognize the effect of this process on revenue as well as other related accounts. Keep in mind that we're looking at this from a process. So the process begins with a transaction. The transaction is a debit to accounts receivable or cash and a credit to sales. At the end of the process is we have a debit to cash and a credit to accounts receivable. So when we're looking at a process and we're focusing on the internal controls based upon the process or the transactions, is we're focusing on the revenue process, the sales process. We also want to focus on the back end where we are collecting the cash. So these two items become a part of our control risk as we are looking at this complete cycle. So the first thing that we want to do is we want to assess the inherent risk. Now, recall the audit risk model. Audit risk, and keep in mind that audit risk is the risk that is the auditor is issuing an unqualified opinion when in fact there are qualified misstatements. This is the product of three items: inherent risk, control risk, and the detection risk. So in the inherent risk, what we're looking at is we're looking at the nature of these financial statement accounts and the underlying assets and transactions as they relate to the revenue cycle. We also want to understand what fraud risks are. Now, as we understand the inherent risk and fraud risk, what we're interested in doing as an audit team is brainstorming in terms of determining the strengths and weaknesses of the internal control structure and based upon our planning of our analytical procedures. So in this planning process, where we are assessing the risk of material misstatement, we are gathering this evidence related to inherent risk, we're gathering evidence related to fraud, we're gathering evidence related to the control structure within the organization. Once we have this, we as an audit team need to get together and brainstorm in terms of what are the strengths, what are the weaknesses, and we also include the analytical procedures in this, and based upon this information we determine the risk of material misstatement. So let's talk about some very specific inherent risk issues related to revenue. The criteria for determining revenue for revenue recognition includes persuasive evidence of an arrangement that should exist, delivery should have occurred, or services should have been rendered, the selling price should be fixed or determinable, collections should be reasonably assured, and then we'll talk about some additional standards later on related to emerging issues related to this topic. So let's talk specifically about accounts receivable. Accounts receivable inherent risk, and again we're looking at accounts receivable and we're looking at what is the nature of these accounts that is going to create risk for the auditor. Receivables pledged as collateral against specific loans with restrictive use. So this is really related to the rights to the asset, the management assertion of rights, and if there has been pledges it's very possible that this is going to affect the valuation of this asset. Receivables incorrectly classified as current when in fact the probability of getting paid within the next year is low. Collection of receivables contingent on specific events that cannot be estimated. Payment not required until the purchaser sells the product to its end customer. It's very important that we understand where our client is in relationship to the supply chain. And if they're selling to an intermediary who's selling to another intermediary who's ultimately selling to the end user, it's very possible that there are arrangements in the supply chain pipeline that in fact, if the goods are not sold, that they can then be returned. We need to understand this. Accounts receivable aged incorrectly, potentially uncollectible amounts not recognized. This is specifically related to a valuation issue, and in fact as part of our valuation process it's very important for us to understand the allowance for doubtful account and how it's collected, and we're going to be doing some very specific procedures related to this account. Orders accepted from customers with poor credit, but the allowance for doubtful account not increased accordingly. The concern that we have, especially as we are working with the client in this risk assessment process, is if we determine that there is a risk from an environmental or external risk related to the organization that is encouraging the client to become very aggressive in terms of sales, it's very possible that they may be selling to customers with less than stellar credit. Well, this is clearly going to ultimately affect the organization, and as we're looking at this, we absolutely need to understand how this is going to affect our allowance for doubtful account. Now, just one point, and we'll talk about it a little bit later, is understanding some of these is going to be based upon our analytical procedures, and in fact, as we assess the days sales outstanding, it's very possible that we're going to be able to identify periods where they have been lax with their credit procedures related to customers. Okay, so we've identified inherent risk. Now let's focus on specific fraud risks related to the risk of material misstatement. Here are some specific fraud schemes that have been uncovered by the SEC and the PCAOB. Recognition of revenue on shipments that never occurred, hidden side letters given to customers with an irrevocable right to return the product. This relates to what we were talking about before, where it's possible that within the supply chain that there are customers that are considering it's very possible or easy to return the product if in fact they're not able to sell it. Recording consignment sales as final sales, somewhat related to the earlier issue. Creation of fictitious invoices, shipment of more product than the customer ordered, early recognition of sales that occurred after the end of the fiscal period. As an auditor, we have specific roles. We have specific functions that we need to perform in relationship to fraud. We need to assess the motivation to enhance revenue because of either internal or external pressures. This is why it's very important that we understand the entity and its environment. We need to understand the competitive environment. We also need to understand the economic environment, because these are going to play into the motivations on management to generate sales. Review financial statements through a preliminary analytical procedure, which we'll talk about in a few minutes, recognizing that not all the fraud will be instigated by management. It's very possible that there may be fraud that's being perpetrated not at the management level, but at the ground level, maybe someone in accounts receivable, a sales rep, a billing clerk, collection person. These people may be instituting their own fraud schemes to generate revenue for themselves. Be aware of representations made by management to analysts. So we want to make sure that management is not promising things that they're not able to deliver. Determine whether the company's performance is significantly different from the rest of the industry or the economy. Determine whether the accounting system is being investigated, and consider management compensation schemes. Again, some of this stuff is we're going to identify as we were going through this process of brainstorming. Determining whether accounting functions are centralized. Centralized accounting versus non-centralized accounting is appropriate depending upon circumstances, but if we have a decentralized accounting function, we absolutely need to be aware that that increases the risk, maybe not at the corporate level, but certainly at the local level where these decentralized pieces of the organization are completing transactions. Understand any complex sales arrangements. Assess whether the company has a history of aggressive sales interpretation. Determine any uninterrupted history of growth in earnings per share that provides incentives to continue to grow at the same pace. This item actually is a very key indicator of possible earnings management. Determine if the client has numerous manual journal entries affecting the revenue cycle. Again, there is nothing intrinsically wrong with journal entries. However, manual journal entries are these items that if they are present, they have it creates the means by which someone can perpetrate a fraud. So let's talk about this from identifying and assessing the control risk related to this process. Okay, so again, where are we? Well, we are looking at the inherent risk. We're looking at the risk of fraud. Now we are considering the control risk. The control risk is basically what management is doing in terms of implementing internal controls to prevent these bad things from happening, basically these items that we've identified in our inherent risk assessment. This requires that we understand the internal controls for an integrated audit as well as for a financial statement only audit. So again, we're doing the integrated audit for the 404 testing. We're doing our financial statement audit if this is not a public company and we're not doing the internal control testing and we're not providing an opinion of internal controls. Such understanding is gained by means of a walkthrough. Inquiry and observation is probably the key way that we identify the internal control structure. This is simply working with management as well as people that are doing their job and observing and asking questions. It's very important that we understand what's taking place. Seeing things, asking questions is very helpful to this process. We ultimately want to review client documentation. We'll talk a little bit more about this, but in fact we talked about this when we were in our sampling seminar, and we talked in terms of sampling is the attribute sampling where we're looking at internal controls and we're looking at an internal control attribute that validates that in fact the internal control is working appropriately. As an example, a second signature on a check is the attribute that we would be looking. This is part of our test of controls. We need to understand internal controls at the entity-wide level as well as at the transactions. So one of the things that we need to focus on is when we're looking at controls and testing controls, we are doing this from the perspective of transactions. From an entity-wide perspective, we need to understand the structure within the organization based upon the COSO model in terms of the control framework, this tone at the top. We probably will be talking to the human resources to understand the competencies of accounting. We also need to understand the independence of the board of directors. So let's talk about specific controls related to specific management assertions. The first one that we're looking at is controls related to existence. So this provides reasonable assurance that sales and accounts receivables are recorded only when shipments have occurred and the primary revenue producing activity has been performed. So we're looking for when we generate a revenue transaction. We've done this because we have a sales event, and that sales event has taken place. We need to understand the mitigating risks related to unearned revenue. We also need to understand any unusual transactions requiring a high level of management control. Now we're talking about completeness. Now keep in mind that completeness and existence are complementary to us. So in completeness, what we want to make sure of is that everything that should have been recorded actually has been recorded. Using pre-numbered shipping documents and sales invoices and its subsequent accounting structure. So basically what we're looking for is we're looking for pre-numbered shipping documents, and we would be looking for exceptions. Same things with the sales. We would also reconcile this, and you notice the last item, reconciliation of inventory with sales. Well, we also want to reconcile the shipping with sales. Reconcile shipping records with billing records. Reconcile shipping records with sales. And if it reconciles, if the item was sold, we say it was sold. If we say the item was shipped, and we say the item was billed, chances are that is a complete transaction. What we're looking for is exceptions. So did we receive a sales invoice but we didn't ship it? Or did we ship something that we didn't sell? And on the billing end, we certainly would be interested in if we sold it and we shipped it but we didn't bill it. That would be a problem. We certainly don't want to bill things that were not shipped. So there should be a reconciliation between shipping, selling, and our billing. Okay? So this is all related to our completeness. Now what we want to focus on is valuation. So you notice the first item here is sales are made from an authorized price list. It's very important that there are specific controls related to authorized pricing at the sales personnel level. We probably will not be giving the sales personnel any latitude in terms of price discounts. Maybe there's price discounts that can come from a higher level within the organization. From an auditor's perspective, we're interested in finding out what the items were sold for, and if there were exceptions to the list price, were these exceptions authorized, and was the authorization documented? Valuation issues arise from uncertain or unusual sales terms, returns, and allowances. We need to have policies and procedures for identifying and recording returned goods. Returned goods is one of those things that is a part of business, but we absolutely need to control this, primarily because we need to make sure that revenue is reported correctly, but we also need to understand that the return process can in fact be a means or part of a scheme for someone to perpetrate a fraud. When we're looking at valuation, we also want to consider the goods that have been returned. We need to understand that there is a pre-numbered documentation system. And anytime we have a pre-numbered documentation system, we're looking for exceptions. We're looking for the same number twice, or we're looking for gaps in the numbering. These gaps in the numbering may in fact mean that something is taking place. We need to determine and identify the credit policies and make sure these credit policies are appropriate and they're being followed. We also need to understand any potential for obsolescence or defects in goods. We clearly want to have proper classification and develop and implement a sales return reserve methodology. So very similar to what we might do in terms of assessing our allowance for doubtful account. We can assess sales with a reserve allowance, and this essentially smooths the impact of returns on revenue and creates a mechanism where we're able to track the sales returns a little bit better. So let's now talk about analytical procedures. So we're talking specifically related to analytical procedures that help us assess the risk of material misstatement. We talked about a couple of things earlier, but let's identify some very specific steps that we need. We need to identify suitable analytical procedures. Analytical procedures are simply mathematical models or ratios that help us understand the relationship between data. So once we have this, we need to compare this to prior years. We also need to be able to compare this to industry standards. And if we do this correctly, what we're able to do is we're able to identify exceptions. This does not mean that something bad has happened. It's only going to direct us into an attention or into an area that may in fact provide some additional insights. We need to develop expectations, and again, these expectations are based upon prior years or industry standards. Identify any significant or unexpected differences and investigate this. So as an example, we talked about the days sales outstanding. Days sales outstanding, assuming we have a structured policy related to the credit approval, should be fairly structured, fairly standard from year to year. Exceptions would be if there's an economic downturn, but also the exception would be if they made a significant change in the policy. Well, if they did, and they did not account for the sales appropriately with the allowance for doubtful account, it's very possible that the days sales outstanding is going to increase. So we need to understand how the change in the ratio actually helps us understand what may be taking place behind the scenes. If we're looking at the gross profit or the percent of cost of goods sold to sales, this may in fact provide some insight in terms of issues related to raw materials, or maybe we've done discounting, or there's been obsolete products that have been discontinued. There's a lot of things that we can identify from this. The ratio is not going to tell us what went wrong, but it's going to give us something to investigate. And this investigation process is going to be there to help us understand what is taking place. How do we respond to identifying risks? Well, we develop an audit approach that contains substantive procedures and, if appropriate, test of controls. So these further audit procedures that we talk about based upon the standards are going to be the substantive procedures, where we are measuring monetary misstatement, as well as additional test of controls. And these additional test of controls is based upon the Sarbanes-Oxley 404 testing. So how do we respond? Well, we use the term the nature, timing, and extent of the further audit procedures, or the substantive procedures. So we're considering sufficiency. Sufficiency is the amount. We are also considering the appropriateness of the selected procedures. The appropriateness of the procedures are going to be based upon the relevant assertion, and we're customizing the audit program based upon our assessment of risk. When we think about our test of controls, we've talked a little bit about this, but I want to spend just a couple of slides related to talking about what it is that we're trying to do. Well, we're looking at a control perspective from an entity-wide perspective. So from the entity-wide perspective, we need to understand the management structure, we need to understand the audit committee, we need to understand how the organization is hiring and firing people. So we need to understand from an entity level if we have the right people, if the structure is appropriate for our control environment. The next thing that we want to focus on is our test of transactions. So again, as we are looking at the risk of material misstatement from the control perspective, we're looking at it from a process or a transactional perspective. So a sales transaction. Now a sales account balance is going to be part of our substantive procedures, but from a transactional perspective, we're looking at it from a control perspective. We're going to do this by making inquiries. We're going to do this by making observations, and we've already talked about how we might be able to inspect documents to confirm that the control has been performed. Reperformance of a control by the individual testing the control is another part of our testing procedures. The analysis of the test of controls is based upon if the control deficiencies are identified or if no control deficiencies are identified. So what we're saying here is based upon our risk of material misstatement. If the risk of material misstatement is high, then this basically means that we've identified control deficiencies, and what we need to understand at this point is assess and determine the severity of these, possibly modify preliminary control risk assessment, document the implementation or the implications of the control deficiencies in our working papers. If no control deficiencies are identified, we determine that the preliminary assessment is low and appropriate. So no control deficiencies means that management is doing a good job in terms of controlling for the risks that are affecting the organization. If that's taking place, we determine the extent of controls that can provide evidence on the correctness of the account balance, and then finally determine our planned level of substantive audit procedures. So in this part of the process, we are taking a specific business process, and in this case revenue, and cutting it up and dividing it into segments where we're looking at our inherent risk, we're identifying fraud risk, we're identifying the control risk. Based upon this is we identify or determine the risk of material misstatement. None of this is related to measuring monetary misstatement, but this is setting the stage for our substantive procedures, and it's our substantive procedures where we are measuring monetary misstatement, which we're going to be talking about in our next lecture. So in this case, I thank you very much for your time,